Today, I'm going to focus on questions that investors have about funds. What is a fund? Why a fund? What are the composition of a fund? What are the advantages and disadvantages of a fund? Are there ways to structure funds that are more investor friendly and less investor friendly? Let's get into it. So, what is a fund? A fund is different than a syndication in the sense that a fund is a collection of assets. At Rockstep, our fund is called Hometown America, and our target composition is 5 to 7 shopping centers. So a fund has multiple assets, different than a syndication. So a syndication is, at least in the shopping center sector, we're going to buy that shopping center, and we're going to raise equity, raise funds just to buy that shopping center. In a fund, we raise funds into a fund so that we can buy multiple assets in the fund. So, summary, fund, multiple assets, syndication, one asset. Now, why do people have funds? Here at Rockstep, we have our first fund because funds are a requirement by many sellers. And when I say funds, it could be other types of committed capital, but basically callable capital or ready cash. Many sellers, particularly distressed assets and opportunistic type of assets, the seller says, you know what, you buyer, if you say, yeah, I'll buy it for $10 million and I'm going to put together my equity within 60 days after we win the letter of intent. Sellers don't like that. They're saying, I'm not going to award you the deal unless you have committed capital, most likely in the form of a fund. So the advantage of a fund to the sponsor is that they can more quickly close an asset and they can get better deals. Now, the advantage for the investor is that the fund gives you diversification. An investor could get diversification if they invest in multiple syndications. So let's say they like the shopping center sector and they're going to invest in that deal, and then the sponsor, a different sponsor, brings a second deal and they say, you know what, I'm going to be in the shopping center sector and I'm just not going to invest in one deal. I'm going to commit over a period of 1 or 2 or 3 years into three deals, 5 deals, 7 deals. Okay? You can do your own diversification in a syndication structure and effectively build a set of independent assets. The fund does that initially. Now, what's a disadvantage of a fund? There's several disadvantages of a fund. One is it's just more complex. Managing a fund, structuring a fund, thinking about a fund, it's just more complex. Number 2, an investor is giving the sponsor the right to choose the asset. And so the investor is saying, I don't want to say yes, no on that property, yes, this one, no, that one. Doesn't have that right. The investor is saying, I like the sponsor, I like the strategy, I want to have part of my investment in that strategy. I will commit into a fund, have at it, go at it, have a good time. Okay? That's what an investor is saying. Less control, less headache, more diversification. Let's talk about an investment period. When a fund is structured, it is structured with 2 basic time periods. The first time period is called the investment period. Generally, investment periods are structured from 1 to 3 years. What that means is from the date of the first closing, when the sponsor buys the first property in that fund, until the date of the last closing, the sponsor has the ability to invest over a period of time. So typically investment periods are 1.5 to 2 years, and if the goal is 5 to 7 properties, the sponsor will typically buy one every quarter to fill up the bucket within that 1.5 to 2 year investment period. After the investment period, you have basically the harvest period. That is where the sponsor works at trying to create value or to create returns. And when the sponsor has maximized the returns on that investment, the sponsor will go ahead and sell it. So let's call it 2-year investment period, 5-year harvest period. An investor could be in the deal at the very beginning of the investment period for up to 7 or 8 years. Or if they invested towards the end of the investment period, it might be 5 or 6 years. So it's important to understand those two types of concepts. Now, let's take a look at different ways of dealing with closings. Okay, and there's two general structures about how sponsors take committed funds from their investors. One is first in, first out, and the other is proportional. So let's say an investor invests $1 million into the fund. In a first in, first out, the first property is bought, the sponsor calls all $1 million, and it goes into that first closing. Subsequent investors will be called at a later time. If it's proportional, if you invest $1 million and the goal is 5 properties, then the sponsor will call 20% of your capital over the investment period, not 100% of your capital. The disadvantage of calling it proportionally is that you might have your capital sitting during a portion of the investment period. If the investment period is 2 years, you might get 20% called at the beginning, at the first closing, 20% 3 months later, 20%, 5 months later, up until the end of the investment period. And your capital is not working. So the advantage of first in, first out is that from the date your capital is called, it's working. Let's look at structures that can be used to improve what I call investor fairness. Okay, so there's two concepts in terms of waterfalls in a fund. One is called the European waterfall, and the other one is called the American waterfall. So let's take a look at how these are different. So let's say you have a fund and you have property 1, 2, 3, 4, and 5. There are 5 assets in the fund. Under the European waterfall, which is advantageous to the investor, if you sell property 1 and you make a good profit, you return the equity to the investor, and any additional profit is used to return the equity to the investor. And after the equity has been returned for all of the investors and all of the assets, then the sponsor gets a promote or a profit. In the American waterfall, if you make a profit here on property 1, the sponsor receives a promote on property 1, even if property 2, 3, 4, and 5 bomb out. So it's not good for the investor. Now, sometimes fund structures will say, hey, if you make a lot of money here, you investor, and you bomb out here, we're going to claw it back. We're going to say, hey, sponsor, return some of the money. But what if the sponsor doesn't have the money? Spend it somewhere else so they go bankrupt. That's an exposure for the investor. By far, the best structure is what is called European waterfall. These operate as a group in terms of you got to get all of your capital back and your preferred return before the sponsor gets any kind of profit. This is a better structure for investors and what we have in our Hometown America Fund 1. Second, I want to talk about anti-dilution provisions. And these are sophisticated concepts that sometimes investors dealing with funds might not recognize. Let's say you buy property 1 and then 4 months later, you buy property 2, 4 months later, 3, 4 months later, 4, and 4 months later, 5. And then, so you're here basically a year and 6 months after you did your first closing. And so the investor here might have an advantage investing late if assets 1, 2, 3, and 4 have appreciated in value. And so if each unit is $1,000 per unit, and he comes in at $1,000 per unit, but these properties have appreciated in value, he has a windfall. So it's important that a fund has an anti-dilution mechanism. And that means that people who come in late, if the properties have appreciated or depreciated, it could work both ways, then they come in at the current valuation. How do you do that? That means that at the acquisition of property 2, 4 months after property 1, you do an appraisal. If the value is exactly the same, 4 months later for property 1, when property 2 is bought, the investors in property 2 will be in at $1,000 a unit. But let's say that appraisal's done and that property's increased in value for whatever reason. Then they might have to pay $1,025 to get in. And down here, they might have to pay $1,100 per unit. This is a fairness provision that's called an anti-dilution provision. And we do have that at Rockstep, Hometown America Fund 1. So, in summary, as we look at a fund has the advantage of diversification. The disadvantage that an investor doesn't get to choose what they're investing in. They're investing in a sponsor and they're investing in a strategy. Again, the advantage is diversification. Disadvantage is you really don't get to choose. The investment period is the period of time from the first closing until the last closing. And then the harvest period is the time that the sponsor uses to create value for those investments. So if you're an early investor in the fund and the investment period is 1.5 years and the harvest period is 5 years, you might be in that fund for 6.5 years. Now you're getting a return from the date of the first closing, but you could be in there a little bit longer than just the harvest period. First in, first out versus proportional capital calls are the two different ways of dealing with capital calls. And this is for the acquisition capital call. So one way is you commit to a fund and the next closing, all of your capital is called and used to purchase that asset in the fund. It could be the first, it could be the third asset in the fund. The other approach is proportional, that says I'm committing $1 million into the fund, and if there's 5 assets, each time there's an asset called, they're going to pull a certain portion of my committed capital. And finally, in terms of fairness structure, it's important for investors to ask the fund sponsor if they're using a European waterfall. European waterfall says that the sponsor does not get their profit, their promote, until all of the capital is back for all of the assets in the fund and all the investment in the fund. Versus the American waterfall that says each asset, the profit can go to the sponsor if that property does well in that single asset, even though the other assets have not performed yet or have performed poorly. Why do sponsors have funds? Sponsors have funds because particularly in distressed assets or in opportunistic type of real estate, which is where we at Rockstep spend a lot of our time investing, the sellers, oftentimes lenders that are selling assets that have been foreclosed upon, they require committed capital, and that if you have a syndication where you say, seller, lender, we're going to go ahead and raise $5 million within 60 days of you awarding us the deal, they're going to say, nope, I'd rather have a buyer that has money in the bank or has a fund with committed capital. So, all in all, fund structures generally allow for quicker closes and, in some of the sectors in commercial real estate, better acquisition prices. And if you get a better deal at acquisition, it is very influential in terms of determining the overall profitability of that investment.